Most trading strategies look amazing in backtests, beautiful equity curves, perfect profit growth. But the moment traders go live, everything collapses. So the question is, how should algorithmic trading strategies actually be tested? In this video, I'll walk you through the process I personally use when evaluating a new trading strategy, step by step. And one of these steps is something many traders completely ignore. Skipping this step is one of the biggest reasons why perfect backtests fail in real markets. Hi everyone, welcome to the channel. Here we explore algorithmic trading research, strategy optimization, and systematic trading frameworks. Today I want to show you how I test algorithmic trading strategies from scratch. This process is not about chasing the highest profit curve. It's about understanding how a strategy behaves. The first mistake many traders make is starting directly with optimization. They open the strategy tester and start changing parameters randomly. But before running any backtest, you should start with a hypothesis. What market behavior are you trying to capture? For example, trend continuation, mean reversion, or breakout momentum. Without a clear hypothesis, optimization becomes random parameter searching. And random searching almost always leads to overfitting. Once the strategy idea is defined, the next step is defining the testing environment. Before running any test, I always define three things: the market, the time frame, and the historical period. For example, XAUUSD 15-minute time frame from 2014 to 2026. Defining the environment first makes the research structured and repeatable. But even with a clear idea and environment, there is something important to understand. Markets do not behave the same way over time. They move through different regimes. For example, if we look at gold. From around 2014 to 2015, gold was in a strong downtrend. From 2016 to 2019, the market was mostly sideways. In 2020, gold experienced a strong bullish move. And from around 2024 onward, gold entered another strong upward regime. If a strategy is designed to capture trend continuation, its performance will naturally vary across these periods. So when testing strategies, it's important to understand how different market regimes affect performance. Once the market environment is clear, we translate the idea into trading logic. Personally, I like to design strategies using a three-layer model: direction, location, and trigger. Direction defines the overall market bias. Location identifies favorable price zones. Trigger defines the precise entry condition. Separating these layers makes strategies easier to analyze and improve. Before running any backtest, risk rules must be clearly defined. This includes stop loss, distance, position sizing, take profit, logic, spread, limits, and execution assumptions. A trading strategy without risk rules is not really a strategy. It is only an entry signal. Now many traders think the next step is optimization. But actually, that's still too early. Before optimization, I always run a single basic backtest. The purpose is not evaluating performance. The purpose is verifying behavior. I check whether orders execute correctly, stop losses trigger properly, position sizing behaves as expected. This step is essentially debugging the strategy. Once the strategy behaves correctly, we can start analyzing statistics. Instead of focusing only on total profit, I examine several metrics: profit factor, maximum drawdown, trade count, average win versus average loss. These statistics often reveal far more than the equity curve itself. Now we finally reach the step many traders are excited about: optimization. Optimization tests different parameter combinations to explore how the strategy behaves. But the goal is not to find the highest profit. Instead, the goal is to find stable behavior across different parameter zones. If a strategy only works with one exact parameter set, there is a strong chance it is curve-fitted. And here is the step many traders ignore: out-of-sample testing. For example, optimize the strategy on data from 2014 to 2023, then test the same parameters on data from 2024 onward. If performance collapses outside the optimization period, the strategy is probably overfitted. Testing algorithmic trading strategies is not about chasing perfect backtests. It is about understanding behavior, risk characteristics, and robustness. A backtest is not proof. It is only the first filter. If you're interested in algorithmic trading research, strategy optimization, and systematic trading frameworks, consider subscribing to the channel. And I'll see you in the next experiment.